Business investment is the economy's sleeping giant, and it's having a hard time waking up. Its snooze is going on 7 years now, and some fear it will remain groggy at best. They have a point. Most economic growth cycles don't last more than 7 or 8 years. But resurgent investment has been the mark of all truly entrenched growth cycles in recent history. Is there reason to believe that this cycle is fundamentally different from all the others, and that what we have seen in the past few years is all we are really going to get? Some argue rightly that business investment always lags the cycle. However, the lag is never this long, so clearly something is different. That something is capacity utilization. Prior to the crisis of 2008-2009, investment was occurring at a frenzied pace. It was as excessive as the global consumption activity it was trying to keep up with. Enter the global crash, and business suddenly found itself laden with idle capacity. Utilization rates were in dangerous freefall, and clearly there was little need for new investment. Since then, businesses have by and large been using more and more of this surplus plant and equipment to service current orders. Now, can this go on forever? Only as long as there is spare capacity. Here's where the scene is about to change. The U.S. economy, for one, is dangerously short of industrial capacity. Most industries are within a hair's breadth of previous maximum utilization rates. Now, if orders accelerate, the American production machine is in trouble. Bearish analysts believe that faltering U.S. orders are a sign that current growth is tapped out, that we are at the top of a mediocre cycle, and that things will soften. That's hard to believe. Housing markets are still building new units at a pace well below the rate of household formation. By extension, consumption is also well shy of normal rates, even in the face of stronger growth in employment, savings, wages, and confidence. The potential for soaring industrial orders is there, so the capacity issue is critical. Pressures seem greatest in the auto sector. U.S. auto sales are back to previous peak rates, but even so, the fleet of vehicles on the road is still quite a bit older than normal. As in other sectors, sales still have a lot of potential to grow. However, capacity is currently bursting at the seams at 107% of pre-crisis levels. Investments in new capacity are surging, but they don't appear to be keeping up with demand. The problem with tight overall capacity is that an economy can lose the capacity to add to its capacity, putting the order books in even greater danger. As such, it is no surprise that after a very long lull, new investments in Canada's auto sector are popping up. Last year, Ford won a global product mandate for its Oakville facility and will also build its new supercar in Canada. Honda announced an $857 million multi-year investment in Alliston. Chrysler was not expected to return to Canada, but early this year announced $2 billion in investment for a new model line in its Windsor facility. Other original equipment manufacturers are discussing their future plans. The parts industry has plans of its own. Linamar announced a $500 million investment in Guelph that will add 1,200 new positions. Looks like U.S. capacity constraints are causing the industry to take yet another look at Canadian capabilities. Naysayers believe this is a flash in the pan. They point to Canada's own tight capacity, labor constraints, currency volatility, and a general southward trend in auto sector investment as inhibitors that are alive and well. They have a point, but plunging oil prices may well alleviate the pressures on skilled labor. We still see Canadian capacity to create capacity, and the abrupt reversal in our currency has to have more than one industry executive at least a little interested. The presence of these positive pressures is no guarantee of good times. Securing new investments is still hard work and needs all participants around the table. But times are more promising than they have been in the best part of a decade. The bottom line, There is now plenty of evidence that business investment is ready for a big ramp-up that will take many by surprise. But even in the shovel-ready auto sector, there will be nothing automatic about securing big projects. Until next week, I'm Peter Hall.